What's up, traders? Welcome to this week's episode of the Weekly Watchlist, where I do a technical analysis and give you my thoughts on the tickers listed up above. We'll of course be checking in on the broad market. After that, we've got our core list of companies, and if you stick with me towards the end of today's video, I've got 3 additional trade ideas to share with you, so definitely stay tuned for that. As always, anything that we are associated with is linked down below in the description, and without further ado, let's jump right into the charts. So kicking things off on the SPY weekly time frame, talking about candle structure and location as we always do. For structure this past week, we've certainly got a solid green-bodied bar with just a little bit of a lower wick here, indicating that the buyers clearly stepped up off of the lows and were able to close prices up at the top edge of the weekly range here. So from a structural perspective, certainly strikes me as being much more bullish than bearish. From a location standpoint, on the bar-to-bar count, we produced a significant higher high as well as a higher low. So again, another bullish data point here on the weekly time frame chart. Let's not forget, though, that the overwhelming trend is still down. We've got highs, lower highs, and the possibility for a lower high, really, as long as we're underneath roughly SPY 430. Something that you can just keep an eye on would be this resistance trend line on the weekly right here, which is also coinciding quite nicely with the weekly 50 SMA. That's the blue moving average for confluence of resistance. What that would suggest, though, is that even if we do get some upward action, right, that is bullish in the short term until we get to that resistance trend line. Now, a moment ago, I called this a significant higher high, and the reason I said that was because we finally have a weekly close over roughly SPY 390, which was prior support, then offering resistance, support for those 2 bars, 1 upper wick of resistance, and in these 2 weekly bars here, also offering some resistance. So this chart certainly is starting to look much more like a breakout as opposed to a meaningful rejection of SPY 390 here. So a question that would be reasonable to at least ask is this the first possible higher low in a sequence that could potentially reverse the weekly trend? It's a possibility and something that's reasonable to be asking at this point in time. The other reason that SPY 390 is so important is because if we take a look from the volume profile perspective, that was the high volume node where we were struggling, and now we've broken out and closed above that in the low volume void. And remembering that markets like to move from high volume node to high volume node, the next one overhead is much closer to SPY 417. Now, I'm not making the argument that we go there in the upcoming week's worth of trade, but it certainly would seem like a valid target from a volume-based perspective. Let's take a look at the daily time frame chart now and see what we've got going on from a price action, psychology, structural perspective. Really, all of those things come together to give us an edge here on the daily time frame chart. So first and foremost, weekly expected move. What do we see? If we're contained in this week's expected move, it certainly would be bullish. Why is that? Because we would produce a higher high up here or a higher low down here at the lower edge of the weekly expected move. Let's not forget the daily trend count looks something like this with higher lows in place. We've got highs, higher highs, as well as a new higher high on the follow-through day on Friday into the end of last week. So I am seeing a reasonable expectation of bullish momentum continuing as long as we get a pullback that is quite respectful early on in the upcoming week. What do I mean by respectful? Ideally, we just want to stay above that weekly level we were just discussing. Technically, the nuanced number is 389.50, okay? So any pullbacks here that come into 389.50 and reverse, extremely bullish. I'll be on the lookout for any hammer candles that print down here, any indecisive dojis, basically any signs that the sellers caught a little bit of a break to the downside, right? Reasonable pullback unfolded, but they're not really pushing their luck underneath that big weekly level. And again, it's confluence with the lower edge of the weekly expected move as well. So bulls are feeling content over 389.50. I probably wouldn't recommend that you chase price action up here, given that we haven't seen a pullback yet. I think the risk of a pullback far outweighs just trying to jump in here and getting to that weekly trend line, which is the dotted line you see up above. So patience will pay here, being, mindful of the risk of a pullback. That's kind of what I'm watching for here. Anything that remains above 394.50 is like rainbows and butterflies for the bulls early on this upcoming week. If it's just mild consolidation, like a 3-bar play sets up and then we break out over the highs, fine, a stop loss can go underneath the lows and we have reasonable room to run to the upside through the overhead gap. Just to let you know what those numbers are, we've got 403 on the downside, roughly closes the gap up towards 408.50, which again is confluence of resistance resistance with not only, you've got a lot of things up here actually. Weekly expected move high, gap close, daily 200 SMA, and weekly trend line up there, all at the same area. Definitely going to be a tricky place for the SPY to resolve, but would, suggest at least that there is some upward room to run to get there in the first place. Now, what if we start moving underneath 389.50? Certainly would seem like the sellers are starting to make a little bit of a stand, but still not all that concerning as long as we're above ultimately 378.50. I'll tell you why momentarily, but the bears, if they are going to make something happen here, it's got to be a move underneath 389.50. It's got to be a lower high underneath 389.50 and then possibly change the daily trend with a lower low underneath wherever it is that the dead cat bounce starts from. Now, 378.50 is so important for a number of reasons. If we take out the trend line tool and look at something like this, a higher low could be produced anywhere kind of around this area. So it's not all that bearish as long as we're above 378.50. I would prefer, again, to see the weekly level respected at 389.50, but that is ultimately the line in the sand here, much closer to 378.50. Another reason why that level is so important is if we take out the Fibonacci's from the low of the move to the top, let's say that this is the high of quote unquote the run that we've seen so far. Notice that your 38.2 is aligned beautifully with that area. You've also got the daily 50 SMA there. It just makes sense that this is a line in the sand for the bulls into the upcoming week. Really can't afford to get back down underneath that level. Remember, 38.2, as long as we're above that, represents bullish consolidation for something that would start to look like a weekly bull flag. Another Fibonacci perspective to at least consider is coming in from the last trend line touch all the way down to the low of 2 CPI prints ago. Notice that in last week's episode, we talked about being back down underneath the 38.2 here. We've now resolved that clearly to the upside. We've recaptured the 50% retracement, and we're knocking on the door of the 61.8. I would just remind you that the more daily closes we can get back above the 61.8, the higher the likelihood of a full-blown 100% retracement. Before we start taking a look at supporting evidence, I would also want you to consider that markets move very similarly, right? In the past, we had this consolidation, break, retest, and rally, break, retest, and rally, right? And this is even like, it gets very, very eerie, right? We have a red bar right here. We gap green over red and get 2 days of continuation. There's your red bar, gap green over red, 2 days of continuation. Notice how the market consolidates here before making that next move. Remember, expansion leads to contraction, contraction leads to expansion. The reason I bring this up is to, again, just recommend that you probably don't chase new money longs here. You wait for some sort of daily bull flag to be put in. You wait for a daily higher low, some sort of pullback, right? That is my recommendation here to stay and play optimally bullish with, respect to risk versus reward. With that being said, let's take a look at our supporting evidence now. This is the market internal screen. If you don't know what this is, top right-hand corner's got you covered with a brief tutorial. Perhaps the most important takeaway from the market internals is that the overcorrelated state from Thursday did correct on Friday with a bullish close as well. This strikes me as a bullish data point. The inflows were positive as well, significant, up and over 300 million, and the tick read was relatively flat. It's not like there was a big divergence in the negative direction. So overall, internals do support more of a bullish look in this market. Let's take a quick look at the market profile. If you don't know what this is, top right-hand corner's got you covered with, yet again, another tutorial. Now, a couple of takeaways here. Number one is that the point of control was left lower in the profile as opposed to migrating higher with price. The other thing, of course, is that we've got an extremely poor high and an extremely poor low. So it makes our trading very simple for the upcoming week's worth of trade, at least early on for Monday. If we start interacting with this high, because it's a poor level, I would expect an intraday break of it. Then it comes down to, do we hold on the other side or do we rotate back down underneath? If we hold above, strikes me as bullish, right? Because we're respecting that level. It was a break of the poor high, repair the structure, and possibly continue in the upward direction. If we break the prior high of day, remember that this just represents Friday, and come back down into range, okay, maybe that's where we start to develop more of a pullback look on that daily time frame chart. The same thing holds true with the lows of Friday. It's a poor level, so the same exact psychology will apply. Interacting with it, I would expect some sort of break just because of how the stop losses work, but if we stay below, look for more of that aggressive pullback, look for that weekly SPY 390 area. If we get back above after a break, so apologies, it would look something like this, and then get back above, maybe it's more of a sign of consolidation and sideways activity in the prior day's range. The last thing I would point out from a volume perspective is the fact that value area did technically shift clean to the upside on Friday. It's not like there was any overlap with the prior day's range, really. So that does strike me as a bullish piece of information as well. Overall, market profile would suggest just keep an eye on Friday's high as well as Friday's low. Let's get back on over to the platform. What else do I have for you? Let's take a look through some sectors from a supporting evidence perspective. Certainly, as I was mentioning in the advanced decline line, the rotations and the fact that the overcorrelated state fixed itself, notice that not everything was green on Friday's follow-through session. Remember, a market that is rotating is a market that's trending. If everything's green, it's going to be very difficult to keep the trend intact. And with this sort of split here, strikes me as healthy, honestly, for a new uptrend possibly building out. Let's take a look through the structural charts, though, and see how the trends are continuing to unfold individually. The XLC is making big strides in the upward direction. It's got to get out of this range, so it's still neutral until it can do so, but it does seem likely that there's at least a possibility of a higher low pullback that would respect the bottom end of the range at this point in time at 48. So this chart is neutral, and if we can get over 50.75 back on the bull side of the market, giving us more of that rotation, because this had been so beat up, if it plays catch up with the remainder of the healthy and strong sectors, that would be a bullish look for the market. Same thing is going to hold true for the XLY, honestly, noting that we're stuck here inside of the range. Again, it's still neutral as of right now, but at least there's the possibility of some sort of higher low pullback, and a break over 148.85 starts to play catch up in the XLY. That would be a very bullish look for your S&P 500. All of the sectors that need to start playing catch up actually had a pretty impressive end of the week. The same thing's going to hold true with the XLK, right? This has been lagging for quite some time. We know that from the ratio grid. Here's the original balance range. We finally closed above it on Friday's session. Now, this also strikes me as a bullish look. It's playing catch up with more of the risk on, or at least better looking charts that we've seen over the past couple of weeks. If the baton can be passed from things like financials, industrials, healthcare, consumer staples, if that can pass the baton to more of the risk on sectors, which it looks like is taking place with these two bullish days and improvements in the XLY and XLC, certainly a good look for the marketplace. XLE is up next. What's going on in the energy sector? Certainly having to balance out the analysis. This is not an ideal look, possibly pushing here into new highs, at least local new highs. The prior highs are much closer to 101, so this could see upward continuation based on more of like a weekly bull flag look. This is D for defensive in terms of the sector and how it performs, so I wouldn't really want to see this breakout here, but just taking it day by day. If we stay remaining in the flag, that would be probably the most ideal outcome for the market into the coming week. I'm just not sure it's going to take place that way with the dollar coming down. Let's take a look at the XLF. What's going on with financials? This is one of those sectors where I think that the baton could be passed along. It's already done the work. Notice the big relative strength, very different from the XLK that we just saw. And we're also coming into this overhead area of resistance. So if the XLF starts to cool off and go sideways here, I wouldn't be surprised to see that happen. But remember that your XLK, XLY, XLC have to pick up the slack by starting to trend in the upward direction and firmly breaking out of those ranges. The ranges, the equivalent of the XLF range is down here. The XLK is just barely poking above that, right? So there's some significant divergence between the two. If XLF is going to take a pause, take a breather, make sure that XLK is picking up the slack. XLB is one of these looks that's very similar, right? Coming into this overhead area of resistance. Chart's been on an absolute run here. Unfortunately, it's such a lightweight sector for the S&P that I wouldn't read into it too much, but the same idea kind of applies. It's not going to make or break the S&P by itself one way or another, but I wouldn't be surprised to see some pullback here. Utilities are looking okay, honestly, because they're not like energy up here at the highs, kind of more muted in the midpoint of this range. Really just don't want to see them get any upward lift over 68.78, noting that we've got thin structure through here. You could easily start to see a rally towards 73.50, which wouldn't be ideal for the S&P 500, remembering that utilities are also D for defensive. Next up is the XLV. Leaving this chart zoomed out, you'll notice a couple of bullish improvements here. However, looks like the chart is starting to slow down. We're no longer underneath the lower edge of the monthly balance. We've talked about this in the past, right? And we are getting some price acceptance towards the midpoint of the range. And you can see there is some reasonable room to run overhead into this gap there. But if we take a look at what happened on Friday, technically we have a look above and fail. Could we be targeting and could we be in store for the bottom end of the range at 130.35? Certainly does seem reasonable. And being the second heaviest weighted component of the S&P, this is going to be fairly significant bearish drag for the S&Ps if things like the XLY, XLK, XLC aren't picking up the slack, right? So this has done the job. It's gotten the bullish acceptance where it needs to. If it takes a pause here, you got to see the slack get picked up, as we've been pointing out in today's video. XLP, this is ironically kind of similar, but not, right? It looked into this balance range from here, but notice the better close outside of and above 73 into the end of the week there. So overall, this chart does strike me as being bullish. It can see some upward continuation. Your next contender would be 74.50. Remember that this also is D for defensive for the market. So you probably want to see it cool off and not necessarily be making strides up here towards 77. But don't forget that, in all of these charts, defensive or not, in the short term, barring the trend, Up days are still bullish for the market, down days are still bearish for the market. It's as simple as that. So will it be bullish pressure? Slightly. It's just not where we want it from a heavyweight distribution perspective. XLRE real estate, what's going on here? Obviously, with rates coming in dramatically after the CPI print, real estate is higher, little consolidation / inverted hammer on Friday's session. I would honestly look for this pattern to resolve higher, so like mild consolidation and pullback, and possibly a breach of 39 gets this back in gear again. Any sort of news coming out from the Fed about rates, if rates pick back up, just expect this to go lower. So it's got to be pretty quiet out there from a headline perspective if real estate's going to continue higher, but overall lightweight sector for the market. Not going to read into it too much. XLI, what's going on in industrials? 8% of the S&P 500. And what you'll notice is just like financials, it's coming into that overhead area of resistance where it could easily start to see some slowdown. With that being said, I'm not going to belabor the point. You know the deal. The baton must be passed, and we must see the picking up of the slack in the three other heavyweight sectors that are much more of a risk on look for the marketplace. The deepest pullback I would want to see in the XLI is roughly around 95.35, the prior breakout point from right around in here. Healthy consolidation, don't get me wrong. Maybe we build out like a weekly flag here and then break out into the future, but as of right now, certainly seems like it could use a little bit of a pullback. Let's take a look through the ratio grid. If you don't know what this screen is, again, I've got another tutorial for you. I've always got you covered. That's one thing we got here. I've always got you covered. Top right-hand corner on how to set this up. Some pretty big improvements in the top four. Remember, these are the risk-on sectors. The XLK looks great, recapturing that descending 50 SMA. Big change in tone from what used to be just a relentless downtrend here, finally starting to look a little bit better. So this is much more of a risk-on look, and certainly aligns with the idea that the baton, as we've pointed out, has already started to be passed from one team to another, so to speak, and the XLK is on the picking up end of that equation. XLV is coming in a little bit. We pointed that out on the structural chart. XLF continues to look great, and XLY as well, with a little bit of an uptick here in the bottom right-hand corner. Overall, starting to get closer to more of a risk-on look in the market. Industrials pulling back a little bit. Remember that this move here really carried a lot of the rally in the S&P 500, so you want to see a mild pullback here, not outright like collapse in this ratio down here. The bottom four are the risk-off sectors, and what do we see? XLP coming in aggressively. This is a healthy look, remembering that it is a D for defensive sector. At first, it looked like it was breaking out over the top of those highs, so to see it coming back down underneath, a much better look. Energy perking up a little bit, but starting to go more sideways as opposed to aggressively trending like it was in here. You want to see this remain sideways, if not slightly lower, into this upcoming week's worth of trade. Utilities, even though the chart looks slightly concerning with that breakout, notice that on a relative basis, it is underperforming the market, which is a good sign, and real estate is just down here because it's lightweight. Overall, no major concerns with that one. What else do we see here from a growth versus value perspective? Notice that this has aggressively come back up and over the low from here, which is a solid look for the market. Remember, we're trying to track the rotation between the old economy stocks that produced and started this rally here, and now we want to see broad-based participation, especially in the growth-oriented stocks, and this improvement, getting back over this 1.88 level, certainly does strike me as a step in the right direction. Bullish look out of this chart on today's session. Dollar, obviously a big breakdown, which is why we see energy continuing higher, but this is a positive force for your S&P 500, noting that when the dollar comes down, usually equities tend to move in the opposite direction, which is up. Let's take a look at the TNX, and there's not much to talk about here. Obviously, the bond market was closed on Friday for the bank holiday, but what we can do is take a look at the TLT, which of course was open, being that it's an ETF. And it just went sideways. So no major concerns. It's not like as the bond markets were closed and banks were closed, they just sold it off aggressively. It just hung in there sideways, which is kind of to be expected. Nothing crazy in that look there. Let's take a look at the HYG, that divergence that we pointed out the other day. So I've got my lines finally loaded up beautifully. You can see that in the S&P, we finally made that higher high. We've talked about this on the daily trend count, but the HYG is just putting in an equal high. So I would continue to monitor this relationship here. If we can't break this red line in the HYG, I probably wouldn't be all that bullish on, again, chasing longs at this point in time in the S&P 500. You want to see this either break, and then we can continue to have a bull bias in the SPY, or if this starts to roll over early, that's when you want to watch for the pullback to unfold in the SPY, roughly to that SPY 390 area that we've been going on and on and on about in today's video. Let's take a look at the SPX A200R. What I want to show you in this particular chart Let's go to the weeklies, actually. So where is the weekly? We've got to do it like this, just so we're looking at the 2008 case, right? That's really the example that I want to compare with today. So the 2008 case, remember, we did make a strong move back to the 0, or 50%, I should call it here, 50% mark. This is stocks trading above their 200 SMA, by the way, in the S&P 500. So the 2008 look is for a retracement to the 50% mark. That's what we have currently. For the bulls to start feeling more comfortable and out of the woods from this type of scenario, obviously we've got to get acceptance back above that 50% mark. So watch for more stocks to start trading above their 200 SMAs, and that would have, bulls obviously feeling much more comfortable here. Let's take a look at the CPI data over the SPX and the Fed funds rate. We talked about this in the Thursday video, but I just want to update anyone who may have missed it. The risk right now, at least, is that inflation could possibly see a double move if the Fed backs off early, right? The risk is that this chart here might look something like this into the future. And this is CPI year over year, by the way. And the whole reason that we bring this up is because rates are still historically very, very low at these areas. So a pivot prematurely could mean more pain in the future. And really what that correlates to, if you look at what happened here in the 70s and early 80s, it's just a flat stock market. Of course, there was more pain in the mid 70s right here, but one step at a time, I think it could lead to, if we prematurely start cutting rates down in the opposite direction again and we see a double move in inflation, more of a flat market, which is obviously just something to be mindful of in this current context, right? Another thing is that the market rallying here is kind of calling Powell's bluff on being higher for longer, right? The market is certainly pricing in much more of a tame move into the future. So here's the December comparison. We've talked about how we're getting more probabilities that we get a 50 basis point rate hike and lower probabilities here that we get a 75 basis point rate hike in the December meeting. And if we go out to February, really the odds of a 25 basis point rate hike is increasing. Odds of another 50 basis point rate hike is decreasing. So the market is pricing in that Powell, we're calling his bluff. And if they have to, and by they I mean the Fed, have to come out with strong rhetoric and beat the market back down, you could see these probabilities change. But as of right now, to me, it looks like the market's kind of trying to see into the future and say, hey, looks like inflation has significantly peaked and the Fed's going to react to that sooner rather than later. Again, it's not like we're trying to get on the right side of that. We're just pointing out that the market sentiment right now is certainly more bullish than bearish, which kind of coincides with the positive looks we've been seeing in the broad market. Let's take a look at some volatility products now and see what's going on from a VIX perspective. Continuing the downward descent. If I pull up the white arrow, there we go. Continuing to make a move lower. We, of course, want to get under 2050 to avoid the 2008 look-alike situation. But overall, again, this is sort of, as it was, here's just like a key takeaway, right? If we zoom in on a little bit of price action here, remember that the VIX moved lower as the FOMC sort of came out and announced rates, right? This is the VIX calling the BS of the Fed right out of the gates, right? So, regardless of the move lower here, VIX moving lower as well. I get it. We were moving into familiar territory as well. But the VIX has sort of forecasted hey, it might look like a bad move on the chart, but it's not really all that bad. When we pair everything together from a CPI perspective, FOMC perspective, and take a look at the VIX and what that sort of forecasted it for us here, obviously it was more of a look that, hey, market's actually kind of fine here. And the same thing has been the case, and we've been making this argument on the channel for the past couple of weeks about the VVIX being at these historically low levels, which would be more of an indication that market participants are quite okay with this acting as a market bottom. Even if it's just a local market bottom, no one's hedged properly and being prepared for a massive down move in the market, which would again be a testament to sentiment that people are quite bullish out there as of right now, at least money managers not being willing to participate in big SPY puts, VIX calls types of positions. The last thing we'll look at from a volatility perspective is the inversion curve. Remember that if we're above the zero line here, we're in backwardation / inversion. That's not where we want to be, and currently big move underneath the zero line for a massive contango. This just would again indicate from a volatility perspective, money managers are certainly more happy to allocate capital when the risk in today's market environment is much lower than the risk possibly in the future. It's not inverted, and again, that is bullish sentiment for the market overall. Let's round out the broad market with the QQQ See what's going on over here. Certainly making a solid move up and over the white line on this chart. This is the balance area we've broken out on Friday's session. Just like in the SPY, I would not necessarily recommend chasing it up here. I think that we could easily see either consolidation or a little bit of a move back down underneath 283.50. That's the breakout level. That's the top of the balance. I think that that could unfold. I just want to be mindful here that, remember, we always talk about expansion, contraction, expansion, contraction. Well, if this is a weekly contraction area, this, although on the daily chart, is a very significant move all the way from the bottom all the way to the top. If this is the beginning of a weekly breakout, this could easily see continuation in the upward direction without pulling back, right? Because this is where all the pent-up energy is. This is day one of the breakout, whereas the S&P has already started that breakout, essentially. It may fizzle out sooner than the QQQ is what I'm getting at. The QQQ has room to play catch-up, right? So overall, just numbers to be mindful of. 283.50, the top of the balance. That's like your go, no-go level in the QQQ. More bullish above, slightly more cautious underneath. I would watch your 50 SMA and lower edge of the weekly expected move as a line in the sand for the bulls, right? If it's going to be a shallow pullback and we truly are going to remain on a breakout, probably don't want to move underneath that level. Otherwise, you jeopardize a look above and fail, right? This is still a possibility. It could be on the table, but I would just watch the weekly bottom end of the expected move. That number is 278.75 roughly. Of course, your gap underneath 273.80 down to 268.55, but overall, the close above on Friday's session, all of the bullish data points that we've looked at thus far certainly would suggest that there could be some reasonable upside here in the QQQ early on in the coming week. Again, just try to find good risk reward, even if it only requires watching a 5-minute chart and placing a stop based on a 5-minute. That's going to help out a ton instead of just blindly chasing it up here on the daily and saying, oh, I don't know, where do I put the stop? Is it here? Is it here? Make sure you have some sort of plan, even if it's on a 5-minute chart, to enter some sort of swing trade. Last but not least, we've got the IWM Russell 2000. Extreme strength here. It's been that way for a while. It's been leading the market. We've been talking about this. There's the original range, break, retest, rally higher, inverted hammer, much more so than all of the candles we've seen in the SPY and the Qs so far. So I would watch for a pullback in the IWM underneath the low of Friday's session. And if that does happen, again, we're A-okay from a trend perspective. We can certainly afford the higher low pullback. Bottom edge of the weekly expected move is 180, 122. And even if the gap closes, I would want to see a higher low off of that area and well above 177, just because on the first pullback here, note that the two equal lows are underneath the level. So even if we pull back to close that gap, it still would produce a daily higher low from this type of trend count perspective. So IWM, it does look bullish, from a trend perspective, but be mindful that it's the most obvious inverted hammer where the sellers stepped up at the highs. We've already touched our 200 SMA. If this sees pullback, this might forecast, okay, underneath 184.80 in the IWM, probably watch for the pullback in the SPY as well as the QQQs into the upcoming week's worth of trade. The last thing I'll leave you off with is the weekly look at all three side by side. We'll close that up so we can get everything here. Again, it all boils down to the big, thick white lines. We're above it in the SPY. We're well above it in the IWM. And the QQQ is finally starting to play some catch up here. Could it start to make that move higher? Definitely seems reasonable. If the QQQ is going to be a weekly double bottom, again, just watch that white line, 283.50. SPY is already above its breakout point. IWM has already pulled back for a retest and held it cleanly. Okay, so if IWM continues to act as a leader, things are looking bullish in this market context. If you've made it to this point in the video, I'm sure you're enjoying the analysis. Hit the thumbs up button and subscribe to the channel so you know every time a new video comes out. And with that being said, we'll dive right into Apple. Notice that Apple's caught in a pretty tricky spot here, right in the midpoint of this overall range. You've got these prior equal highs, equal lows, and now we're much closer to the midpoint as opposed to the edges. Remember that your edge exists here, literally at the edges, for a breakout or mean reversion. Same thing is true but opposite at the bottom, mean reversion or a breakdown. We've already got the mean reversion trade off the bottom end of the range, so that ship has sailed. I wouldn't be chasing it long from that setup perspective. It's much trickier in here towards the midpoint of the range. You don't really have that edge, but let's just make a couple of recommendations. Obviously, buyers want to see prices remain over 146.25 for a flag look like this, and then you can start to target some of these upper levels, 151.75, 156.75. Sellers, you've got to get it back down underneath 143.50. That was an intraday reversal point from Thursday, and then the gap close on the downside will be in play underneath 140.43, closes down towards 138.52. Let's take a look at Netflix. This is going to be very similar Don't get me wrong, it's much closer towards the upper third of the range. If you divide this into thirds, you can see that clear as day, but you probably want to be patient. Like the most patient bulls just want to see the gap continue to fill overhead. That's over 305.62. If you're a nuanced short-term trader, you probably want to see a bull flag here, then continue to the top of the range in the first place. So holding 278.75 is bullish as well. And then bears, you're only getting something going if you take it underneath 265.25. Reason being, you had your chance. There was the 100% retracement and some, putting in a bear flag. And obviously big breakout Thursday and Friday. So bears are only content once again underneath 265.25 here. Next up, we've got Tesla. This one actually looks a little bit more tradable early on in the week as opposed to Apple and Netflix that we just saw. You can currently see that we're building out this little balance range here, and we possibly broke out, from a technical standpoint, we did close above on Friday afternoon session, but watching for continued price acceptance over 194.85, you're just looking for the back test here of 202.25, and when and if we get here, I would monitor very closely for an inverted hammer. Is this just going to be a break, retest, and then roll over back lower? It certainly is a possibility, and noting that Tesla isn't a daily downtrend, it would seem at least favorable to look for a short setup there with tight risk reward and retarget the low edge of the flag. That being said, the secondary setup is that if this rotates back lower early on, then it is just playing out as a bear flag. Breakdowns of the lows get you much closer to 163. Next up, we've got Google. What's going on in GOOGL? If we take a zoom on Google, notice that this too is already, well, I shouldn't say this too, but like Tesla, we're trying to get the back test of the range. It's already here inside of Google. So 96.25 is kind of your pivot point to be watching early on in the coming week. If we get a pullback, which I certainly think would be a likely and reasonable outcome here, I wouldn't recommend chasing new money longs, right? If we get a pullback that's anywhere above this gap, so any high or low above 91.59 is ultimately starting to look much more like an inverted head and shoulders. This is now the neckline at 96.25, which is also prior structure from here. And then it's all about the gap overhead, right? Over 98.30 closes up towards 103. That's a really large range to be trading for in Google. So long trades on the table as long as that higher low gets put in place. If we just consolidate and go sideways and start breaking down underneath, obviously the gap closes to 89.50. Be mindful of that one. Next up, we've got Meta. What's going on in Meta? And this chart is a little bit tricky just because we've got major overlap on the Thursday-Friday session. It's not like we produced any clean structure up here. It's very difficult to be trading through this overhead gap. I would definitely recommend that you should probably contain more of a bullish than bearish slant as we move through this area of thin structure. But again, small size if you're taking these trades. There's no real place that you would put a stop loss from the daily perspective yet. We don't have an obvious area of support that has developed here. So kind of a tricky one in Meta, more like Apple, right? It's kind of in no man's land from a trend perspective. Let's take a look at NVIDIA, definitely the most bullish chart on the board. We've already got more of a clean reversal here. It's been in an uptrend for the longest. It's not really struggling like some of the other charts that we've seen so far. Really, disappointed, to be quite frank with you, on the Wednesday close back down underneath the session there. It made things a little bit more difficult, but nonetheless, we're almost at the target here at 168.50. If we can get towards that area, this is where I would look for shorts early on this week just to capture some pullback, right? We're not shorting here expecting that NVIDIA does something like this. You're just looking for a mild pullback, and a place that could go to is 158.12 from an intraday reversal on Friday. Do be mindful that earnings are around the corner, and this one probably wouldn't hold any options through earnings, but overall, watching for continued extension, a short here for some sort of pullback seems reasonable inside of NVIDIA. When and if that happens and it builds out a bull flag, of course, looking for just trend continuation in the upward direction. Next up, we've got Microsoft. This one's pretty tricky as well because it's made a wall-to-wall move. We've come all the way from the bottom, all the way to the top of this range right here. Apple's, as we just pointed out, closer to the midpoint, but Microsoft's at the top. So our edge is starting to come in play, but after having made a move all the way from the bottom, all the way to the top, it's pretty difficult to recommend new money longs at the highs, right? You want to see some sort of consolidation, some sort of possible higher low, and then a reattempt, and that's where the break is more likely to unfold once the buyers have put in some sort of structure that looks like this. So some levels to be mindful of. Beautiful higher lows, like ideal picture perfect consolidation, put it in a textbook, is over 242.80, and then a break for this gap overhead is the likely outcome that you watch for. The break is over 250.75. If we start getting lower highs on the daily time frame, so if this fails the level, then we do something like this. Of course, your gap close underneath is the next focus for the bears, 235.15 down towards 228.58. Last but not least, we've got the mini beast, what's going on in Amazon. And again, from a structural perspective, this one's like kind of like difficult to pick off. Where is the structure? What is unfolding here? It's certainly more bullish than bearish, as is everything on Thursday and Friday. And I think the biggest takeaway here is that the bears had a bear flag in play, breakdown on Wednesday, and then we gapped over the top of that flag. So all of these shorts are likely feeling pain. If they haven't closed out already, I think bullish price acceptance up here early on in the week gets them nervous for the possible gap close overhead. So that's a situation that I would watch out for. Any further consolidation or acceptance over 97, kind of start watching for this gap to come into play overhead. That's from 104.86 to 109.79. As of right now, the setup isn't, entirely clean for that to be in play, but that's kind of where my head's at in Amazon. Quick reminder to hit the thumbs up button, the subscribe button, the bell button, all of those buttons YouTube tells us to tell you about. And let's get right into these trade ideas. First one is on DOCU, DocuSign, coming back from the dead. This thing has an outstanding short interest, and it certainly made a significant push in the upward direction on Friday. Watching for continued acceptance over 50 to possibly squeeze out some shorts in the upward direction. Notice the uptick in volume as well. If that takes place, I would start to target places like this, closer to 62, 64 in this general area. You might have a little bit of a hang up around 56. But if this, again, big emphasis on the word if, this is going to turn into a short squeeze. These are some of the overhead areas that I would be paying attention to. Be mindful of volume. Short squeezes always happen on extremely high volume. If it's got higher volume than average, definitely could be a possibility here. Next up is LEN on a clean 3-bar play. Notice that we've got 1, 2 consolidation in the upper third. A break of 89.45 puts into play the next target, 92.81. Certainly a reasonable expectation for a single day's worth of price action, even if it takes 2 or 3 days to unfold. Looking for upward activity in LEN based on the beautiful consolidation in the upper third from Friday. Not interested if it breaks down underneath the lows at 87.57. Last but not least, really great looking chart here for a number of reasons. Not only is it a daily double bottom down here, but it's also a cup and handle. And if we were to look at it on a weekly time frame chart, which we will do briefly just so I can show you, this is a multiple inside bar setup, right? We technically have a consolidation doji last week. It's a slightly higher high than the prior bar, but notice that we have prior resistance here as well. And we've got an inside bar here on the weekly too. So if we can break out over 79.39, the next weekly structure you would start to target is closer to, what is that, 83, roughly 84 even. Let's go back to the daily time frame chart and I'll show you that one more time. So continued consolidation, you could call it a cup and handle, you could call it a bull flag, breakouts over 79.39, get interesting for that 84 target that we were just seeing, which was coming from right around in here. So that's what I've got for you in today's video. If you enjoyed it or learned anything new, as always, let me know down below in the comment section or by giving the video a thumbs up. We will be live tomorrow morning at 8:30 as we always are. And with that being said, I wish everybody a green trading week.